All right, so let's just talk about numbers a little bit here. And these are risk. I want to talk about the relationship between multiples. We hear multiples, right, all the time. We don't really hear this language that I'm using, cost of capital, discount rates. Those are, just think about those as returns on investment. So what's the return on investment today for a 10-year Treasury bill? Anybody look? About, nah, the 10 years I think around 3 at this point. It's jumped up quite a bit. What is it? 287. 287? So, but just think about that. So that, you know, to put your money into a Treasury bond for 10 years, theoretically safe investment, depending on the day that you ask, but that's getting you a 3% rate of return. So that's not a high rate of return because why? The risk is low, right? So these are rates of return that you'd see more often in operating businesses. And the math related to the rate of return and the multiple is the discount rate divided, into 1. It's just simple math. So if you have an investment that you say, you know what, I think the rate of return on that ought to be 20%. I ought to be compensated 20% rate of return for my risk, okay? That's a 5 multiple. So when you hear people say, you know, typical sale price of the company is 6 times earnings, okay? That means that they're assigning a rate of return or the risk associated with that investment of 16%, okay? So this is nothing special here, it's just simple math. But we use multiples more so in the real world, you know, when transactions are done, you know, there's usually a range of multiples. Now, what I'm pointing out here is, now I'm going to be careful in saying this. I don't want somebody to come back to me later and say, you said it was, you know, 5 times and I'm, you know, this is a very generic thing I'm about to say. Companies and their values vary by industry significantly. If you have an IT company, that's going to be looked at differently than a manufacturer. If you have a company that's got a lot of intellectual property, patents and stuff, right, there's a lot of intangible value. The other thing that matters in valuations is who the buyers are, right, who the parties are. So, you know, if you're a company in an industry and a third-party larger company says, you know, I really need to be in this industry in this geographic location where they're at, and I'm willing to pay more for that, right? That's called a strategic buyer. This is really not intended to present any of that stuff that's very unique. This is sort of a generic way that we see most private transactions happening, and it's between these ranges. 4 to 7, you could argue maybe 4 to 8, seems to be the multiple of cash flows. And obviously when you're down here at, you know, at 8 times cash flow, that's a pretty well-run company, right? Because the person buying it's only getting a 12% rate of return if they pay 8 times for it, right? Anybody want to add anything, Scott? Anyone else in terms of your experience? What you see when you've done some work here? Okay. So this is what I would say is a range of reasonableness for many companies that are private, okay? And I think it reflects, so if you look at down here, you know, a 10 times, think about the things that are usually in place for something like that. Forget strategic acquirers. But those tend to be companies with, you know, think about like Coca-Cola, for instance. You know, they trade, you know, higher than this. Why? Diversity all over the world, you know, management staffs everywhere. They own that secret formula, right, that just produces, you know, it's a consumable item, it's well run, it just keeps cranking along, it has gigantic scale. That's why those companies trade for much higher, right? If the president of Coca-Cola gets hit by a bus tomorrow, probably nothing's going to happen in the 80 countries that they sell Coca-Cola in because it's so dispersed and it's so managed, right? Those revenue streams are far more predictable. It's a commodity business in many respects. It's consumable. People keep buying it. So their biggest thing is fighting against all the other people trying to, you know, get their shelf space. But when you look at the business in a large scale, there's a part of that business that just, you're just like turning that crank, right? It's so organized and so dispersed that the risk associated with it is low compared to, I don't know, a $20 million manufacturing company with one location in Warminster. Right? Think about it. Think about the different kinds of risks there. Okay? That's why these numbers are the way they are.